Hi, my name is Amit Premchandani and I manage the UTI Dividend Yield Fund. I believe dividend yield strategy can be managed with two approaches. First is high dividend yield strategy with focus on largely capturing the dividend yield. This approach has large sensitivity to interest rate as it is proxy to fixed income investment. The focus here is to invest in high dividend yield companies. The second approach is to focus on dividend growth strategy, combining the elements of yield as well as growth, and hence look at total returns from dividend as well as capital appreciation. Our focus is on the second approach for portfolio construction of UTI Dividend Yield Fund. Conceptually, higher dividend yields are expected to provide downside protection during times of stress, market dislocation, as some part of total return comes from yield as compared to companies which do not pay dividend. Additionally, we have a proactive strategy that aims to reduce the volatility of the fund by avoiding stocks which have higher beta or higher standard deviation. This helps us to reduce the average beta of the portfolio, while we target to keep the standard deviation of the portfolio below the benchmark, which is Nifty 500 index. Our focus on higher cash flow of the businesses has been a hygiene factor in UTI Dividend Yield Fund. Currently, the fund has over 90% of its exposure to companies generating consistent and positive operating cash flows. In many cases, dividend-paying companies have relatively low capex requirement for growth, while they also generate cash, which reduces possibility of the companies to face stress due to leverage. The theme ensures that the portfolio comprises primarily of companies with clean balance sheet in terms of leverage as well as decent cash flow profile. Further, we notice that many of the companies which have traditionally paid high dividend as well as shown steady growth in dividends belong to relatively stable sectors such as FMCG and IT, which are sectors with high payout ratio and high return on capital employed and stable cash flows. Currently, the fund has higher dividend yield, relatively cheaper valuations, better return profiles, and lower risk in terms of standard deviation compared to benchmark. From a long-term perspective, investor looking to reduce the risk of volatility in their portfolio with reasonable growth potential may consider this fund as a part of their core portfolio allocation. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.